basis of, I would think, the basis of our safe haven status, such as it is the mining boom, LNG in particular, iron ore, coal, and so on. And the big miners have just recently, this week, been dampening expectations about all that. Just the next 5 years look tough enough for them. Here's BHP Billiton Chairman Jack Nasser talking about his company's $80 billion project pipeline.
When Marius talked about that $80 billion, I think you're well aware of the environment was different. That's the first thing. The second thing, investors were saying, well, where are the growth projects? And it was, I think, a valiant attempt to say, we have a multitude of choices. And he laid out the choices. He never said we're going to do them all at the same time.
As we stand today, does BHP still intend to spend $80 billion over the next 5 years on growth projects?
No.
That's pretty clear. It was interesting that the BHP share price came off quite a lot after he spoke. In fact, we've got a graph of the resources top 200 and the top 200 stocks overall. Over the past 12 months, the big miners are down 30%. But what's really disturbing is their performance over the past couple of months. BHP and Rio were very ugly on Friday, both down around 4%. So is that a buying opportunity, folks?
I just find this whole issue so reactive, where he says they're going to now cut capital spending because the market's telling them to do that, or investors are telling them to do that, and say they want a dividend. When you've got a company with a depleting resource base and it's a reaction against the Petrohawk acquisition, you know, it seems to be feeding the short-termism in the market again.
Petrohawk is the elephant in the room here. I mean, they spent $20 billion.
This is the US shale gas.
Yeah, an absolute disaster. Absolute disaster. And it was cash flow negative in the last half-year result. And they're too embarrassed to sort of talk about it or take the write down. And so the shareholders have just lost confidence in their ability to deliver on massive spending. And there's also the labour issue in Australia and blowouts.
How much do you think they've lost there?
Over $10 billion. I mean, it all depends where the gas price goes. But they bought it right at the top. If you're buying those assets now, you'd be getting it for sub $10 billion. And one of the biggest offshore disasters in Australian corporate history. And they should be getting really blamed for this.
I thought the rather amusing thing, I can't help pick up the magazine, the Smart Investor had something on the front cover, I don't know whether you can get that, 50 ways to make money from mining. They missed out the 51st, which is go short. Because I wouldn't be buying this trend, you wouldn't be buying this trend. The sector fell 45% in 6 months in 2008. When the sentiment goes, there is no floor in earnings and value.
There's more to it, though, than that. We just need the whole life cycle of a mining company, where we had strong price rises, cash flows, capital spending. Now they've got to deliver projects, and the question is now what you pay for companies that have gone through that phase. And I think that's the real problem, is how do you actually value a mining company? We've not been here before.
No, you've hit the nail on the head. How do you value it? You value it on assumptions about commodity prices, and you don't know what commodity prices are going to be.
All the big miners, from Gazprom to Vale to Anglo American, are all off, and BHP's gone from the third most valuable company in the world to like 17 now. So it's a global trend with all the commodity exposed.
The great thing is the sector always comes back, and this is much better than the equity markets, where everything's being saved all the time. The resources are going to create a fantastic buying opportunity at some point. Yeah.
Well, the other outfit with white knuckles about this is the government, the Treasury in Canberra. We've just got Martin Parkinson, for the new Treasury Secretary, talking about that.
The sorts of issues that have been raised about cost of doing business in Australia, the technological changes that are occurring, and what that might mean for LNG developments in Australia versus gas developments elsewhere. In other words, the sorts of things that Martin Ferguson was mentioning yesterday are actually legitimate issues that we will have to keep an eye on. But I'm not worried about the sort of us suddenly seeing the mining investment boom dissipate.
He hopes.
Well, he's differentiating between mining prices and mining investment boom, and he's right. The big projects are not going to just dissipate completely that quickly. The LNG projects are going to be massive, and they're not going to disappear either. So he's right about we need to, the nuances, the investment boom, not the commodity price boom. But the cash flows of the companies are still very, very strong.
That's right. The budget is assuming a $34 billion increase in overall government revenue. They will already be projecting a deficit of about $10 billion next year, based on the falling commodity prices just since the budget came down. I mean, we're highly exposed to commodity cycles, and it's gone the wrong way to ever deliver this phantom surplus.
There's a few companies going broke at the moment too. I saw building companies in Hilliers go broke the other day. There's quite a lot of pain going on in the non-mining industry, manufacturing and construction in particular. Particularly there's a company called CSR, of course, that's straddling both of those. During the week, CSR posted a normalised full-year profit of 90 million, which was flat compared to last year, but not too bad considering that housing went backwards. I spoke to CSR chief Rob Sindel, who, as you'll hear, reckons the challenging times are far from over for them.